Today, the federal government alone is responsible for $31.5 trillion of the nation's total public debt, which does not even take into account the approximately $3.2 trillion state debt, the $17.1 trillion debt owed by households, and the $24 trillion debt owed by corporations. This phenomenon affects all developed countries, including Italy and Japan, not just the United States. All the money borrowed internationally to fund economic activity is referred to as global debt. In this video, I'll go into further detail on what global debt is and why it has been increasing over time. Before going any further, please hit the like and subscribe button to help the channel out. The United States and Japan, two highly developed nations, borrow money by issuing government bonds. They use this money for a variety of initiatives, including providing public services and building infrastructure. For instance, to fund projects like the construction of roads, schools, or healthcare facilities, the U.S. government may issue treasury bonds and bills. Debt from households and debt from corporations, however, different. Individual and family borrowing is referred to as household debt. People may incur debt for a variety of reasons, including to finance school, buy consumer goods, or buy a home. Common types of household debt include credit card debt, mortgages, and school loans. Household debt, when properly handled, can promote economic activity and raise people's standards of life. And as for corporate debt, companies frequently borrow money to grow their operations, make investments in cutting-edge technology, or buy out companies. For example, a technology company may issue corporate bonds to fund R&D initiatives, and a manufacturing company may take out loans to increase its production capacity. Corporate debt can spur economic growth and innovation by giving businesses the resources they need to succeed. Even while everything appears to be going well, the fact that global debt has exceeded $300 trillion US, nearly 3 times the size of global gross domestic product, GDP, raises serious questions and exposes potential threats for the world economy. Now let's look at the global debt to GDP ratio to evaluate how risky the debt level is. The ability of a nation or the global economy to handle its debt is evaluated using the debt to GDP ratio. A high debt to GDP ratio indicates that, in relation to total economic output, there is a substantial amount of debt. In this instance, the debt burden nearly triples the global GDP, accounting for a sizable share of global economic activity. This makes the sustainability of the debt burden a worry. If the level of debt increases faster than the rate of economic growth, nations or the global economy may find it difficult to pay down their debts. When debt loads are excessively heavy, there is a chance of defaults or a requirement for ongoing borrowing to pay off previous debt, which can result in a debt spiral and financial instability. Consider the 2015 default on Greece's debt and the history of defaults in Argentina. Please feel free to watch a video we made on the Argentinian economy. After studying the types of debt and the reasons why a rising debt level is worrisome, let's examine the differences between both government and private debt. Because the global economy is effectively borrowing from its own future rather than from external entities, government debt functions differently than personal debt. In essence, the government is borrowing money now and will repay it by raising taxes on its citizens or growing economic productivity. However, it will typically be higher taxes. Government bonds, treasury bills, and other securities are issued to pay for the nation's debt. These financial products are offered to domestic and international investors who lend money to the government in return for the assurance of timely interest payments and the repayment of the principal amount at maturity. Meanwhile, loans and credit provided by financial institutions like banks, credit card companies, or other lending corporations are often used to finance individual debt. Individual debt repayment is typically planned out as a series of fixed monthly installments over a predetermined time. This indicates that a government may plan and finance its debt using a variety of levers. For instance, a government might have $1 billion in debt that is about to become due, which essentially means that the bonds will mature and the investors would need to be paid the principal. Instead of paying down the debt, the government can refinancing it by issuing new bonds to replace the older ones that are about to mature. The debt is rolled over throughout this process. Governments frequently restructure their debt in order to control interest rate risk, benefit from opportune market conditions, and prolong debt maturities. However, this lever has been misused to the point where the debt to GDP ratio is now at an all-time high. Additionally, when a government makes a financial default, it demonstrates that it is unable to fulfill its debt obligations. However, defaults on sovereign debt are uncommon, in particular for U.S. government bonds. In the financial markets, U.S. government bonds, which are regarded as the highest grade bonds, are frequently referred to as risk-free investments. This is because the U.S. government has consistently maintained a high credit rating as a result of its capacity to raise money through taxes and its position as a major player in the world economy. As a result, during periods of economic uncertainty, investors view U.S. Treasury bonds as a safe haven. As you can see, even if a high debt to GDP ratio sounds risky, the effects on the government are extremely different. And it can typically be solved. The most crucial question is whether the government can continue issuing bonds with negative real returns. And yes is the response. Even if the bonds' real yields are negative, the government can still issue more debt. For instance, despite low real returns, there can still be enough demand for government bonds from investors looking for a safe haven or from those who need to hold them to diversify their portfolios. And in some nations, it may be mandated by law or rules for financial institutions, pension funds, and other organizations to hold a specific proportion of their assets in government bonds. Concerns regarding the effects of the total world debt, which is approximately 3 times the size of the global GDP and exceeds $300 trillion, have been raised. Although debt can be helpful for financing long-term economic growth projects, prudent management is essential. Through counter-cyclical fiscal policies, governments play a significant part in controlling the debt cycle. Promoting economic stability and success requires transparency, accountability, and long-term planning. Overall, prudent debt management may support a robust and successful world economy.